Hey everyone, in this video we're going to be doing a business review of the company Wendys. We're also going to end it by taking a look at their stock, looking at their valuation, and based off the business review, what my thoughts are, if this is a stock that I'm looking to invest in, or what my concerns with the business are. If you like this type of content, please subscribe to the channel, as well as liking the video. If you own the stock or know more information about the stock, would also love to hear from you in the comments as well. Okay, so we're just going to get right into it. Wendy's, for those of you who don't know, is a quick service restaurant brand primarily operating in the US, but also operates in some global markets and looking to expand their business. Just some quick highlights that they shared on their last earnings call. They've had 12 consecutive quarters of same-store growth, which is obviously good. Their push into breakfast, which we've seen lots of other QSR, quick service restaurant companies do, whether that's Burger King or McDonald's, probably their biggest two competitors. They seem to think it's been performing well, as they've had $3,000 per store weekly sales in just breakfast over the Q4 period. They continue to focus on digital mix, and they continue to open up more stores, so increase their net store count by 2.1% in 2022. Not bad. Also not super aggressive for a company that's still relatively small. And then they just continue to reiterate they have very strong growth ambitions for the company. We'll take a look at the rest of the information to see if we agree with them or not. Now, this is just breaking down those 12 years of same restaurant sales growth. Overall, kind of see they have 1 year and then kind of a 2-year stacked. Let's just look at 1 year. They've been pretty consistent, I'll give them that. But as they've grown for 12 consecutive years, lots of these years are, let's call it just like with inflation, they're not really growing market share. If anything, they're probably losing market share as companies like McDonald's and so on has picked up their same-store sales growth and their stores operating by more. So obviously a good sign that they're not decreasing, but I wouldn't say this has been anything overly impressive, with the exception of maybe 2021 and 2022. We've seen pretty strong years that they're coming off of here. Going into some of their highlights for last fiscal year. So in 2022, they had system-wide sales growth. So that's including those 2.1% net restaurant growth plus the dollars per store of 6.8%. So overall, people spent about 7% more on Wendy's globally than they did in 2021. Not a bad number. Once again, just kind of meeting expectations, in my opinion, for where this company trades versus a crazy outperformance. Company restaurant margin at 14%. So they do franchise restaurants, but they also own a lot themselves. So that's a bit of a difference between this company and McDonald's and some of the other big QSR companies. Wendy's does actually own a good percentage of their restaurants, I believe. Adjusted EBITDA, $500 million. Like, I take that with a grain of salt, because in this business, it's so much depreciation and tax and stuff like that going on, and adjustments. You can really manufacture whatever number you want. So I'll look at the EPS, since it at least includes tax depreciation, of 86 cents as a more reliable indicator of their profitability. And free cash flow is also important. Free cash flow of about $200 million on the year. Okay, so this stock trades for, I believe, about $4.5 billion. We'll go into that later, but that just kind of gives you a sense in terms of their free cash flow multiples, where it's trading for today. And I won't go into valuation too much now, but just so you guys can kind of digest that as we go through the presentation. Okay, now just looking at their data a bit more granularly, we'll see in 2022, based off the numbers we saw, global growth was 8.4% in the fourth quarter. This is a 6.8% on the year that we just talked. So interesting that it was actually a slowdown versus 2021, as it looks like they opened up a lot of international doors, with international growing 20%. So, growth's great. Deceleration's not the best thing to see. but good to see that at least in Q4, they saw a reacceleration of their growth rate over the overall year. Same restaurant sales growth up both in the US and internationally. I wonder if this asterisk is to do with FX or not. Nonetheless, really strong growth on a same store basis internationally, which is good to see, as that's where they're looking to expand more. But it needs to be said, and I highlighted it here with the red box, international is still a very small part of the business. System-wide sales is about 15%, and it looks like they actually own lots of their locations in the US. So 15% of system-wide sales, but probably in profit dollars, it's in the single digits of what international is bringing to the table. So you're really owning a US fast food company here that's hoping to build a US business, but they're really on the early innings of it. And then lastly, just in terms of restaurant growth, at least it looks like you can kind of see net, despite having 8-9 times the restaurant presence in the US than international, they're opening new restaurants internationally at the same pace, if not faster than in the US. So that's really where they're trying to grow their mix, grow their presence. And you're seeing that come to life on the net restaurant openings. Okay. In terms of how they're going to deliver growth, they kind of highlight three things, very logical. The first one is same restaurant sales growth. Obviously, to drive growth on your overall business, you want your existing businesses that you have open to do more sales. Open up new franchises and new locations and footprint expansion. Obviously, the more doors you have, the more sales you can do. And then the third one that they're focusing on is digital acceleration. So focusing on their app, loyalty, getting people to order through their app. We've seen a lot of success for some businesses, most notably McDonald's, Starbucks, on really driving a lot of growth, a lot of engagement, a lot of loyalty through their app. So in lots of respects, as I look at lots of the things that Wendy's doing, it really reminds me of McDonald's 5 years ago, which isn't that much of a compliment. It kind of seems like they've sat back, learned, and now they're adjusting. And it's really hard to disrupt when you're such a small company, and they probably wanted to see what McDonald's did with their investments. McDonald's can also scale it across 10 times as many restaurants. So the ROI of making those investments pays out a lot easier for a bigger business like McDonald's or Starbucks. But at least they're focusing on it now, and hopefully that really helps them down the road in the next 3 to 5 years in terms of acting as a accelerator of the overall business. But this is just a pretty logical slide. We want to make more sales in the stores we have. We want to open up new stores. We want to better tie in digital to drive incremental sales and purchases. Okay, in terms of how they plan to grow and kind of giving you a good feel about where the company's going, they have over 300 potential franchisees in the recruitment pipeline. So they're saying, okay, we already have 300 potential franchisees who want to open up franchises. So there's demand, there's interest in expanding the business and opening up new Wendys by potential partners who want to run them and buy the franchising rights. They're looking at really enhancing the stores by doing rebuilds, but ones that are done with reduced build costs. So lots of these rebuilds that the brands want to do really makes the brands look better, but lots of the locations are hesitant to invest that kind of money to actually do them. So it's really good that they're focusing on and calling out reduced build cost, because that really helps the tension between the franchisees and the corporation in order to get on the same page. So they're calling that out ahead of time, knowing that that's coming, and calls out enhanced profitability. Hopefully that's not a soundbite, and that's really what their objective is with that plan. And then I looked into this Pacesetter development incentive that they just launched, and it's really waiving franchise fees and advertising fees as a percentage of sales for new franchisees for the first 3 years. So that's really just trying to incentivize an acceleration of this pipeline, getting more and more people interested in opening a Wendy's, knowing that your payback period, I think they said, is going from 3 years that you have to run the business essentially to pay back your initial investment down to 2 years by wiping out those fees associated with opening a new location. Obviously, this makes it a lot less lucrative on day one for Wendy's in terms of the money and the checks that they're getting to help these businesses get set up. But they're really focusing on feeding their pipeline of royalties down the road, which I think could be a good strategy as long as, investors are willing to keep that and acknowledge that for the first couple years, that this is really a long-term strategy to get more entrepreneurs opening up Wendy's because they're offering them a better payback period than other investment opportunities in franchising. And then they just kind of call out some targets here. Expect annual net unit growth of 2 to 3% over the next couple years. I think that's achievable, but it's also like a pretty lackluster forecast. It's not like they're saying, hey, we have a lot of room to catch up to a lot of demand to open up new locations. We're going to be opening up 5% more a year. They're really just saying 2%, which is achievable. I think they'll do it, but doesn't really let you build too much upside into their financials, especially knowing they're not going to be getting lots of those revenues until years down the line based off this Pacesetter development incentive. Okay, so just wanted to do a look at their global presence. They're saying over 23 to 25, so over the next 3 years, 70% of their restaurant growth will be international. They're highlighting Mexico, Canada, Europe, specifically Ireland, Spain, UK, and then India and the Philippines. So these are kind of markets that they've kind of highlighted as opportunities areas that they're looking to open up new restaurants, which I think is good to diversify out of the U.S. Obviously, the type of food they sell is very U.S. centric, and it's like mostly like a healthy. I don't want to call it healthy, but it's like a burger joint. But we see those kinds of companies, whether it's Burger King, obviously McDonald's, perform really well globally. So it'll be good to diversify the business a bit away just from the U.S. and one market specifically. And then what do they think is going to happen to get to 6 to 8% of system-wide sales growth? So it looks like it's really just this 2 to 3% it's 2 to 3% of new store openings, and then 3 to 4% of same store growth. So this essentially with inflation, this based off the plans and the opportunities they've seen, I think this is a very reasonable forecast, but once again, nothing really to write home about to get to 6% sales growth for this year, and then mid-single annual growth for the next couple of years too. So pretty standard, let's call it 5-6% sales growth over the next 2 to 3 years on this business. Free cash flow, probably what I care about more if I was a shareholder. They're projecting $270 million in free cash flow next year, and then looking to grow that high single digits 2024 onwards. I don't get how they're accelerating their growth of free cash flow when they're waiving lots of their franchise fees for their growth areas. So if they're going to only get more free cash flow from more royalties from existing same-store sales growth going up, or from new unit growth in terms of store counts, and they're waiving all the fees for new unit growth, then I don't get how it accelerates their free cash flow to double digits. But nonetheless, that's just doesn't pass my personal sniff test. I'm sure there's other things that I'm missing in that equation. But still, from 22 to 23, pretty strong growth. So just important to note, $213 million of free cash flow this year, $270 million next year as we look at the valuations a bit. Now, one thing that perplexed me a bit, great for shareholders right now, but I don't fully understand, is how aggressively they are returning capital to shareholders after drawing out this plan on how they have opportunities to invest in growth and enter new channels, new businesses, focusing on breakfast, needing to invest in digital. Seems like they're in investment mode. And it's like, no, they're actually doubling their dividend to have the highest dividend in the QSR space that I'm aware of, at about 4.5%. McDonald's is at 2%, 2.5%. Some other QSR restaurants are in that 2 to 3% range as well. Not only are we doubling our dividend to $1 annually, even though we only made 86 cents last year and are projecting 95 cents this year, but we're going to also call out that we're resuming share buybacks of $500 million, which is like over 10% of their market cap. So I don't know where all this money's coming from unless they're taking on debt. But as a shareholder, or not as a shareholder, if I was a shareholder, I'd just be concerned on like, what are their priorities in terms of paying a dividend, buying back shares, reducing debt, opening new stores, investing in digital. Like, what is truly the priority? Because it seems like they're saying the businesses and they have opportunities on the business to exponentially grow shareholder value, but then they're giving up all this money to shareholders today. So it was very confusing for me to understand where they were going with this and how they're going to get the money to do this responsibly. Going into this slide here, just commented on it, but adjusted EPS for the year is 95 cents to $1 for 2023 outlook. So even if they hit their outlook, their EPS is 100% being given to shareholders via the dividend. And then they're also looking to do buybacks. Just not seeing this add up for a company that is saying that they're a growth company with investment opportunities in digital and global expansion. Okay, this should be interesting. Capital allocation policy remains unchanged. So number 1 is to continue to invest in the business for growth. Number 2 is sustain an attractive dividend. And then number 3 is excess cash for repurchase shares or reducing debt. Okay, so, not to harp on it, it's like number 1 is to invest in the business, but it really seems like number 2 is your priority here. If you're doubling the dividend to a higher amount than you're making annually, your first priority is really sustain an attractive dividend, since that's clearly where literally 100% of your earnings power is going to. And then whatever is left over after that is for investing in the business. So optically, I get why they put this first, but their actions are speaking something different, in my personal opinion. Number 3, we'll look at the balance sheet, but in my opinion, there is no way this company should be buying back shares, 1, at their current valuation, but 2, just based off the amount of debt they have on their balance sheet. So that paired with how they're talking about the dividend relative to why they're investing in growth as a priority is making me a bit wary about this business. So looking at the balance sheet here, I'll give them this. They do, for a $4.5 billion market cap company and a company that does about $250 million in free cash flow a year, they do have a really good amount of cash on hand at about $750 million. But it looks like $500 million of that is because they just took out more debt, about $500 million more debt. So, take that with a bit of a grain of salt. It's not like they prudently built that balance sheet over time. They literally just decided having $4.5 billion of total liabilities, which is the whole value of their company, wasn't enough, and they want to be more levered. So they took out another $500 million in debt. In terms of this number, $3 billion in long-term debt is a huge number. If they were paying 4% interest on that, that's like 110 to 120 million just in interest payments for a business that entirely generates 213 million in free cash flow. So before before they paid interest, they were probably at 330 million. So just on this long-term debt, the interest payment caused them to cut their free cash flow by 35%. I may be missing something here, but it just seems like this company is super levered, and I know they have the assets to cover for it, but realistically, the interest payment on $400 million of current liabilities, $2.9 billion on long-term debt before getting into lease liabilities, which I don't really count because it's part of their month-to-month operation, is more debt than I'm comfortable paying for a company at a premium valuation. And to think that they have this amount of debt, they just took out $500 million more, and they're buying back shares with it and doubling the dividend. Like, my head's just somewhere different than this leadership team. Obviously, they think they're in a great financial spot, and they can expand their leverage like this. If I was them, even at pre that $500 million debt they took out, I would still want to get this under $2 billion. So they're just, I don't want to say playing a dangerous game, but they seem to be putting their foot on the gas. They're much more aggressive than I would be if I were them. And that's my biggest concern with this company. Looking at the stock price, you see here that double dividend, $4 or 4.5% yield. So a great yield on this business, really attractive, especially for what I'd call a really good brand, especially in the US, and a reasonable growth trajectory. I think for a company that's going to do under $1 or about $1 of EPS in 2023, trading at 22 times wouldn't be unreasonable if they had a good balance sheet. But I am not paying 22 times earnings for a restaurant company who is not showing that they are willing to invest at the same rate as their competitors to unlock future growth, and is also not at the same caliber as McDonald's or some of those other top restaurant companies that are demanding similar to slightly higher valuations with a much better balance sheet, in my opinion. So at a good balance sheet, I think they deserve this multiple. At the balance sheet they have, I'd be wary to pay over 20 PE for sure. I'd probably be looking at something like 17 times, and I'd probably still only buy if it seemed like they had appetite to reduce their leverage, which they clearly don't. So this is one I'll probably stay away from. But I do love the company. Their business looks like it's on the right path. I just don't think the right levers are getting pulled corporately and on a capital allocation level. So because of that, this is one that personally I'd pass on despite the juicy 4.5% dividend, which seems to be a bit volatile seeing as it's over or at 100% payout ratio and just doubled over the last year. But I'll look for other opportunities personally. But would love to hear if you guys would own this stock, if the balance sheet is as big of a deal for you as it is for me. If you have any other thoughts on the company that I may have missed, both qualitatively or quantitatively, if you've looked into this company or have shares in this company, would love to hear from you guys in the comments. If you guys haven't yet, would love if you subscribe to the channel. We're still a small channel, so every little bit helps, especially if you give a thumbs up. Would really appreciate that, and I'll see you guys in the next one.